we might see some, I think that this large rise in interest rates has caused lots of distortions, and that's why we're seeing some of these losses. The question is, what's going to happen next? Will the rates keep going up, or is the Federal Reserve about to pivot? I think they're between the devil and the deep blue sea. It's a bit like a rabbit in the headlights. They don't know whether to raise the rates to try and rein in inflation, which is one of their mandates, or whether they have to lower them to try and keep the economy alive. But the trouble with both is there's some downsides.
Hello and welcome to What the Finance, another episode of What the Finance podcast. I'm really looking forward to welcoming back Clive Thompson today, who's a retired wealth manager from Switzerland. And his interview last time was fascinating. I think it was very eye-opening. I'm sure we'll have a lot to talk about again. So Clive, thanks for joining the podcast today.
Hello, Anthony. It's been quite a tumultuous month since we last spoke. I think we've had at least 4 banks gone bust, and the takeover by UBS of Credit Suisse. So perhaps we'll just talk about that for a minute.
Yeah, exactly. And I think too much, that word, it's almost underplaying what's happened. I think it's been even worse than that. But if you just want to go over it.
So it all started a few weeks ago when one of the banks in America suddenly started to get into trouble because depositors were withdrawing their money. And what had happened, this bank had invested a lot of their money into government bonds, long-dated government bonds, which were falling in price due to the rise in US interest rates. So some short sellers saw that this was going on and realized that as people withdrew their money, the bank would have to sell these bonds, crystallizing losses, which would wipe out their capital. So there was a run on the bank, and then we shortly after that had Silicon Valley Bank, which was a much larger bank. Same problem, and then the short sellers went on a hunt for any other bank which was in the same kind of situation. Meanwhile, we had going on in Switzerland Credit Suisse, which has been in trouble for quite some time, despite the assurances by the Swiss government, by the Swiss National Bank, and it meets all the regulatory requirements for sufficient capital. But people didn't care. They were taking their money out, and billions were leaving the bank on a daily basis. And then the final nail of the coffin came when the Saudis, who had invested in Credit Suisse, said, we are not going to invest anymore. And they were quite adamant about that, which with hindsight for them, because the share price continued downwards. I mean, it literally crashed on those words. And finally, we got to, I think, Wednesday, a week and a half ago, when the Swiss National Bank and FINMA issued a statement saying everything's wonderful, nothing can go wrong. We're giving it our full backing, and we're going to pump money into it as much as is needed to keep them alive. That was on Wednesday. And then by Sunday, they decided that the bank had to be saved by UBS. So they engineered a takeover by UBS. They wrote down the bonds, these are a special type of bonds issued by Credit Suisse, to zero, but the shareholders were going to get paid something like 80, 70, 90 cents by UBS. And that's created a lot of friction because there's many investors in these bonds, and I'm not talking about retail investors because that really aren't any retail investors in these bonds. These bonds are a special type of bonds reserved for ultra high net worth individuals or for institutions like hedge funds and pension funds. And when I say reserved for them, the rules to get into them are very, very strict. You have to sign a lot of papers. You have to know what you're doing. Because the type of bonds which were written down to zero are the type of bonds which are designed to keep financial institutions alive if they get into difficulty. In other words, typically these bonds can turn into equity. In the case of Credit Suisse, the wording wasn't that they'll turn into equity. It was they go to nothing. And the regulator did what they were allowed to do and said, an event has occurred, the specific event being we put in a lot of money from public funds, and that's written in black and white in the prospectus. if that happens, those bonds go to nothing. You have no right of recourse or anything. So those bonds are written off, and Credit Suisse, the shareholders got a small pittance. It's only a fraction of what they got. I think they got 80 cents, but the share price, if we go back a year ago, was tens of Swiss francs, and if we go back several years, it was probably a lot higher than that. So people have lost a lot of their money. And here in Switzerland, I have many friends and neighbors who are shareholders in Credit Suisse, and they basically see their money wiped out. They've ended up with perhaps 5% or 2% of what they started with. So there's a lot of disgruntled Swiss investors as well. And in other places, there's a lot of hedge funds who are feeling quite upset about their bonds. So that's where we've got to. But is the world saved, is the big question. And I think the next line of attack, which is coming, is related to commercial real estate loans. I saw a table produced just today, actually this morning, of all the banks which have commercial real estate loans massively in excess of their capital reserves. And given that government bonds themselves are down by 20-odd%, one can only assume that real estate loans that banks have made, if they were marked to market, are worth a lot less, because they're riskier than government bonds, and therefore if government bonds are falling 20%, you could expect that real estate loans, if they could be marked to market, would be worth a lot less. So I think that we're going to see some banks attacked by the short sellers in the coming days over real estate loans, and it does make the system very fragile. Meanwhile, the Federal Reserve and the FDIC in America have basically said we're going to bail out all the depositors of Silicon Valley Bank, 100%, not the 250,000 assured. That's created quite a ruckus in Congress. They were questioning Janet Yellen or Jerome Powell, I don't remember, but anyway, they were questioning as to why all the investors in Silicon Valley were being bailed out, since some of these investors might be members of the Chinese Communist Party. And I found that a rather weird comment to make. She had a very, very good answer, which was basically, there's no rule of law which says we can be racist in who we pay and who we don't. So basically everybody's going to get paid 100%. But the next question is, will you get paid if you're in a different bank? And there was no clear answer to that. But I think the way I understand it is, if the bank is deemed to be systematically important in America, you're likely to get bailed out 100%, but not necessarily if it's a small bank. So, of course, people in small banks are worried, and they're moving their money into money market funds and moving it to large banks. And so far, we've seen some of the large banks letting it back to the small banks to compensate them for the money out. But what we have is a very fragile system. There certainly is not enough money in the FDIC to bail out a wholesale run on the banking system. And I think everybody's hoping that won't happen. But and I think it won't. But obviously, there are some dangers here. Most banks don't have a lot of very large depositors above the 250,000 level. What was special about Silicon Valley Bank was that most of the depositors were in the millions, and that was a bit of a worry. But so that, as Janet Yellen said in Congress the other day, she said, we don't normally expect to have a run on a bank which has most deposits below 250,000 because they're insured, and we're hoping that won't happen. But who knows how the public will act. There's a number of things which have changed since 2008, when we had these banking runs. If we go back to 2008, I'd like to think back to Washington Mutual. That took several weeks for about 12 or 16 billion to be withdrawn. On the last day before Silicon Bank shut its doors, the withdrawals, if they hadn't shut the doors, would have been 100 billion in a single day. So many times what took weeks for the withdrawals from Washington Mutual, which went bust. So that's an important change which has happened in the last 10 years. Things have speeded up. You can move money around at the touch of a button. And that's one factor which makes the whole system a lot more fragile than it was back in 2008, when the central banks had time to think through and save the banks one after another, slowly but surely. In the system we are today, if everybody presses the button today, they can start moving their money, and who knows where they're going to move it to. But I think the direction of travel for a lot of people is money market funds, which do diversify where they deposit their money. But again, they're going to be cautious about the banks which are losing it and won't be depositing it there.
Yeah, we covered so many topics there. It's crazy things how much has happened. So if we look at, you mentioned real estate, and it's specifically company real estate, corporate real estate, sorry. And you see that as really maybe the risk moving forward. And I guess if we look at this isn't houses, or I guess it depends on the market. So in the US, if I'm thinking about this correctly, regular houses, those mortgages are government backed, so they're actually collateral that you can give to the Fed and they'll reimburse you. But I'm assuming the corporate mortgages that you're talking about don't come under that, so the banks have to have these unrealized losses on their balance sheet. Is that correct?
Yes. So when a bank lends money, whether it be to a corporation or to an individual for a mortgage, if it's a long-term loan, if it's at a fixed interest, that loan will have been fixed at a rate of interest which is below the current market rate, below what they could get otherwise today. Now, I'm going to just illustrate for you my personal mortgage. When I took out my mortgage here in Switzerland, interest rates were negative, 0.75% negative. Now, I didn't mean to say I'm paying a negative rate, because they never offer you a negative rate when you borrow money. But let's just say the rate at the time I borrowed was about 2% below what I would pay today to borrow. And I've got another, let's call it another 10 years on my mortgage for simplicity, at which they could have lent today at 2% more. So that means over 10 years, they're losing out on 20%. So if I was to go to my bank and say, I'll give you 80% for my mortgage to buy it back off you instead of the 100 I owe you, of course they're going to say no. But it wouldn't be such a bad deal. It'd be a very good deal for them if I offered them 90%. But I'm sure they're going to say no, because that would crystallize a loss for them, and losses are what causes banks' capital to be wiped out. But you can imagine my loan is definitely not worth 100% to my bank, because they could lend it to somebody else for 2% more than I'm paying. And the same applies to fixed term loans of all kinds, whether it be to corporations for real estate, whether it be to mortgages, or just a general corporate loan. Now, I did touch more on, I was thinking more along the commercial real estate. One of the problems we're seeing with commercial real estate is that a lot of tenants, they have fixed term leases, they're 5-10 year leases, but they're now experiencing the work at home phenomenon, and whether employers like it or not, the reality is many people are starting to work at home, and the only way you can keep some of your employees is to allow them some days at home. So the reality is offices are sometimes half empty, sometimes 2/3 empty, sometimes 1/3 empty. The lessee does not need to rent as many floors as he's renting at the moment, but he can't get out of the lease until it renews in 3, 5, 10 years, whatever the term is. But as these leases come to the term, they'll be saying to their landlord, I'm really sorry, but we used to rent 3 floors, we only need 2 floors. Or maybe we're going to do a little bit of hot desking, we only need 1 floor. So the landlord is faced with some dilemma, what he's going to do. Can he fill those other 2 floors? Are there tenants who are willing to pay him the same rent for the other 2 floors or not? That's the dilemma of the landlord. But the other dilemma the landlord will be facing is that the interest rates will be double or triple what they were when he first took out the loan at the start of the lease. So we're faced with a situation where perhaps a typical landlord maybe had 15,000 of rent coming in and 5,000 going out in interest payments. lease maturity, that 15,000 lease is perhaps only going to be 5,000 coming in, and that 5,000 interest he was paying might now be 15,000. So he's gone from 15 in, 5 out, to 5 in and 15 out. So he's going from a profit of 10,000 to a loss of 10,000. So what's his real estate worth then? Obviously, if he hasn't got any money, he might just hand the keys back. And I think that in some cases he might not be able to keep paying the or financing the loan, and that does mean we'll see some. And this is absolutely for sure. We are going to see a lot of defaults in the commercial real estate sector over the coming years, and that will hit the banks because they'll try and sell these properties, and unless they're selling about a third of the price or half the price, there won't be any takers, because nobody's going to buy a property at the old price when you haven't got tenants in it.
Yeah, and do you think that would be in the, I guess, the cities which are probably the most inflated? So you can think of like San Francisco, London, New York, Los Angeles, probably those places, Sydney, those places where just the commercial real estate prices just have absolutely shot up over the past 10 years. And now we're probably going to see the opposite phenomenon moving forward.
Yeah, those places which were the most squeezed on the upside will be the most squeezed on the downside. But there's going to be nowhere which is going to be exempt from this. Across the world, office space will not be in such demand as it was. Now, I hear often that there's a counter argument that people will redesign these offices, they'll rebuild them, they'll do whatever they have to do to put into apartments, for example. That's all well and good, but first of all, it costs a lot of money to do that. So you've got to have the capital and be prepared to do it and know you could get it back. And the other problem is, in many cases, it's not as simple as you think. Often office blocks are open plan type office blocks with windows around the four sides, but that's not really a suitable shape for a block of apartments. Apartments have smaller rooms, and therefore they need windows in at least a certain number of the rooms, most of the rooms, to be honest. And that's not going to be so easy to organize when you've got a large square building, which is typically, I would say typical, but in many cases, much, much larger than you would have been able to build a block of apartments. You simply can't put an apartment in the middle of a building with no windows. It just can't be done.
Yeah, and I can imagine there'd be planning difficulties as well with the councils or the regions about changing it over to different use.
Yeah, so I think a lot of landlords just won't have the appetite to, or the money to do these changes, and so a lot of real estate will come on the market. It will be sold by the banks because in many cases the owner will be unable to repay the mortgage, so it'll be now in the bank's hands. And I can see quite a large decline from the peak in real estate prices. I estimated at least 50% off the peak prices from here. Prices are well down. Of course, prices are already well down to reflect that, but they're going to go further down.
Yeah, it's crazy to think. So if you look at the banks that have most exposure to that, were you able to sort of find out which ones have the most exposure to commercial real estate?
I did have a look at the list, and to be honest with you, I did not recognize any of the names. So they're not the big Wall Street banks that we all know, like Bank of America and things like that. No, it's not. It's lots of look like little community banks. But there's the problem. People are going to be taking their money out of some of these banks, putting it in money market funds or the large banks, and they're all going to be in trouble in some way. And we'll see what happens. But the money to bail them out, I'm not sure what the appetite of the Federal Reserve, the Treasury, the FDIC, and the taxpayer, ultimately, because it is the taxpayer, will be to bail these out. Will it be necessary? That's another question. I mean, in practice, maybe the investors don't need to take the money out if they feel they're fully insured. But if that confidence evaporates, you can see a lot of people trying to move their money into something which they perceive as safer.
Yeah, definitely. So what does this mean for banking, I guess, worldwide? Do you think we're going to see banks become more utilities and they're not going to be, I guess, maybe they'll be just normal loans for normal individuals, but they maybe won't be doing as risky things? Or what's your opinion on that?
Well, I think a lot of the smaller banks are probably doing fairly mundane things. They're lending money to people to buy houses, and they're lending to local businesses. They probably have a lot of very strong relationships with the people they're dealing with, as opposed to the big, large banks who, to a large extent, don't really know their customers except for the very largest. So I don't really see any change in their for the smaller banks and in their day-to-day activities. But for sure, the very large banks will be reining in their riskiest activities. Every risk manager in every bank will be saying, are we at risk? Where are we at risk? What can we do about it? And that means if you're a major borrower from a large bank, you might see your credit lines pared back a bit or a lot. If you're a hedge fund manager with trading lines secured on maybe 2 or 3 lines of stock, which is one of the things which Credit Suisse discovered when they were exposed to Archegos. They lost 5 billion or something like that. I think the banks are going to say we want a better quality mix of securities than just 2 or 3 stocks. So a lot of things can, there will be an impact, and there'll be a drawing in of the horns by the big lenders, and they'll cut back the risk lines for their traders, saying, okay, you used to be able to trade up to 20 million a day or 10 million a day, whatever the figure is. I think they'll be reducing the traders' lines as well and telling them that they can't trade as wildly as they used to, because they just don't want to find themselves at the wrong end of something.
It'd be interesting if that actually caused more concentration, I guess, in the big companies in the US. Because if you look at like the recent run we've seen, majority of those gains have been in, I think, 8 of the largest companies in the markets, and I think the other 492 have had negative returns. So it could actually be where we see further concentration in the Apples, the Metas, the Amazons, Nvidia, all those companies compared to others, because the banks are that maybe that's the only credit line that these hedge funds can get.
I think that's a possibility. We have more concentration in the hands of the large banks. I think the other thing I'd just like to touch on is what we've seen with the rise in interest rates. We have seen a very, very rapid and steep rise in US interest rates. That to some extent has been followed by other countries around the world. I think I read that it's the steepest we've ever seen in terms of timescale. That whenever you have a large change in price of anything, and this time we're talking about interest rates, there's always people at the wrong end of it, always. We've seen countless situations. I mean, a very recent one we saw was last year was the nickel price, which went to the moon, and it turned out there was a Chinese company who literally had sold billions and billions of nickel that they didn't have, and then they literally had to close the exchange for a day and cancel all the contracts. With which the nickel exchange, the level metal exchange, is being sued now by people who are disgruntled because they were the ones who would have made money, and now their contracts are cancelled to the benefit of the Chinaman who lost all his money. We might see some, I think that this large rise in interest rates has caused lots of distortions, and that's why we're seeing some of these losses. The question is, what's going to happen next? Will the rates keep going up? Or is the Federal Reserve about to pivot? I think they're between the devil and the deep blue sea. It's a bit like a rabbit in the headlights. They don't know whether to raise the rates to try and rein in inflation, which is one of their mandates, or whether they have to lower them to try and keep the economy alive. But the trouble with both is there's some downsides. If they raise rates, they exacerbate an already very fragile problem and potentially damage the economy. We don't know how bad the economy will get. Right now, the jobs figures seem to be very good, but that could turn around rapidly. So maybe there's a little bit of room left to raise rates by 0.25%, but it's a risky move. On the other hand, if they lower rates, we start to see a loss of confidence in the US government. We see a lot of confidence in the ability to maintain the value of the dollar, because you should put the rates above inflation if you want to try and reduce inflation. But of course, it could ease things. If you ask me, I think they'll probably stand pat at the next meeting, and then they'll start to lower. And the reason I think they'll probably lower is, one, because they don't want to have a banking crisis. They want to kick it down the road as far as they possibly can, and they'll risk a little bit of inflation for longer, but they'll still be talking about bringing it back to 2% down the line. So I think my guess is that we won't have any more rises in interest rates, but the market, just to say, the market is currently predicting a 0.25% rise, but yeah, that's a bold move if they do it. Now, the other reason I think they might have to bring interest rates down is the state of the Federal Reserve's balance sheet itself. The Federal Reserve is in exactly the same situation as the banks it's saving. So we've just seen in the last few days, the Federal Reserve published its 31st December annual accounts. These are the audited accounts. And in the middle of these accounts, on page 30-something, you can find the amount of loss they are carrying on their books on their treasury securities. And give or take, it's about $1.1 trillion of loss. That means the securities are, on a mark-to-market basis, are worth 1.1 trillion less than they are on the balance sheet as being worth. Now, the Federal Reserve's capital reserves are about 40-something billion. So the capital reserves are at only a tiny fraction of what they have lost in mark-to-market value. Now, in this respect, there's no false accounting going on. It's because it's in accordance with the Federal Reserve's accounting manual, which was written by the Federal Reserve itself. So they've written their own accounting rules. So they're complying with their own accounting rules, which, according to the auditor, do not follow normal accounting rules and commonly accepted standards as they would apply to companies. But that's fine. They're within the law to call an asset worth 100, but it's only worth 80. That's allowed under the rules. And one could argue that if they keep these securities long enough, for the next 10 years or whatever, they'll ultimately mature at 100%, even though they're worth 80. But that fails to recognize the fact that there's about $350 billion of securities booked in those numbers at more than 100%. So even though these securities will ultimately mature at 100, they're not going to mature at 106 or 110 or whatever the Federal Reserve paid for them when they bought them. So that money, even though it's still booked as an asset, it doesn't exist, and it's ultimately never, and it never will exist, even if they, unless they bring interest rates down to 1%, and they go down to 1% at the long end, which I don't think many people see that happening today, but it's a possibility. But lowering interest rates would ease that situation a little bit, because presumably as interest rates come down, those bond prices would rise, and they would look a little bit more solvent than the currently insolvent position they're in. The other thing to say about the Federal Reserve is they're losing money every week. It's about $2 billion a week is being lost. And the reason they're losing money every week, that's on a current basis, and that's on an accounting basis, which they are accounting for. So the reason they're losing money is they're paying their depositors, which are money market funds and depository institutions like large banks. They're paying their depositors money market rates, close to 5%. But that's that's the money they owe to the banks, the money they owe to the money market funds. But on the other side of the coin, what are they earning? They're earning the interest rate on their portfolio of mortgage-backed securities and on their portfolio of treasury bonds, of which more than half have a maturity in excess of 10 years. And the average rate of interest on these securities is only slightly above 2. So they're paying out 4 and they're earning 2. That's as if you had a job and you're earning, let's say, 10,000 a month, but you're spending 20,000 a month on your credit card. You're going backwards on a day-by-day basis. So even on that metric alone, the Fed has already wiped out its capital reserves. Except when you look at the balance sheet, apparently the capital reserves are still there. And I'll tell you why they're still there. The reason is they're booking that loss as if it was an asset, which is allowed under the Federal Reserve's accounting manual. So no false accounting, but no company could get away with calling a loss an asset. And the reason they book it as an asset, and it's explained in the Federal Reserve accounting manual, is because it's money they don't have to pay to the Treasury. Because normally, and this has been the case throughout all of history, the Federal Reserve has been making a profit, and every week it pays its profit to the Treasury. But from September, when they started making losses, when they raised the interest rates, they stopped paying money to Treasury, and they can't pay any money to Treasury because they've got nothing to pay the Treasury with. So they're accumulating these losses, and because they don't have to pay the Treasury because they don't have to pay the Treasury anything until they've recouped those losses, they're going to call those losses an asset. It's a bit like saying I've got a tax credit, which maybe I'll be able to use it one day, but I can't use it today, so I'll call it an asset. So it's a weird form of accounting, but we've never been here before with a central bank. I've tried to check everywhere if central banks can go bust, and everywhere I read, no, it's impossible for a central bank to go bust because at the end of the day, they can print, this is what people write anyway, they can print money and create capital. So of course, this would be an unheard of transaction or never be done before by the Federal Reserve, because the capital was put in by the Treasury, not by the Federal Reserve printing its own capital. It's like a company saying, we'll print our own capital so we're not bust. It wouldn't make any sense. But yeah, maybe who knows what accounting is possible if they get into a problem. I don't think they're going to get a problem because they've got 2 trillion of cash banknotes that they've issued. That's a liability, but it's a liability which will never have to be paid, because if Joe Bloggs comes in with his $100, what are they going to give him in exchange? $100 in exchange. So he can only change his banknotes for banknotes. It would be a problem if those banknotes go out of circulation and are replaced by bank deposits. So if, for example, they move over to cash falls into disuse and all those banknotes are now in the banks and the banks are now depositing it with the Federal Reserve, now it's a problem, because if all the banks come along to the Federal Reserve and ask for their money back, it won't be there. But whilst that 2 trillion of banknotes is floating around the system somewhere, even if all the banks come and demand their money back from the Federal Reserve, there's still going to be some change left. There's going to be about 1 trillion left already.
So what you're saying is because the Fed and the Treasury are different, the Treasury is the one that funds the Fed. That's why there's the potential for them to go bankrupt, but it's very unlikely. And I guess you could say that almost, if it were to get to that stage, it'd almost maybe be a marriage between the two, and maybe they'd join forces or something like that.
Yeah, I think this might be a good moment to explain to your listeners the difference between the Federal Reserve and the Treasury. The Treasury, headed by Janet Yellen, is an arm of the government. It's the department which is in charge of the IRS. They collect the taxes. It's the department which is in charge of the departments which hand out the government spending, the pensions, the salaries. So basically, the Treasury is effectively the bank of the government, collecting the taxes and paying out the salaries to all and sundry and everybody who gets money from everyone who is entitled to something from the government, including pensioners and welfare payments and government employees and everything else. So on the other side, we have the Federal Reserve, which is the central bank. The central bank's job is to issue the currency of the United States and to lend to the Treasury. Because the problem that we have and have had for donkey's years is that the Treasury spends more than it can collect in taxes, and big time more. So this is why you're hearing a lot about the debt ceiling. So every few years, the government hits the legally authorized debt ceiling, which is authorized by the government, and they can't borrow anymore. And that is, the Treasury may not borrow anymore. So we just step back a minute. In normal times, the Treasury has to pay the bills. It hasn't got enough money. So it goes along to the Federal Reserve and says, would you lend us another trillion, please, or 100 billion, or whatever the figure is that they need that week. And the Federal Reserve says, sure, give us a bond paying 2% and we'll give you some cash paying 0. So the Federal Reserve hands the Treasury a 100 billion bond paying 2 billion a year in interest. And the Federal Reserve electronically prints 100 billion of dollars and hands it to the Treasury, who then goes and spends it. Now, that was a real gravy train for the Federal Reserve up until September, because up until September, they were effectively printing money, paying 0 interest, and earning on that bond 2%. So you can imagine it's new desks, Dolly Bird secretaries, new computers, a real life of doesn't matter how much we spend. But of course, over time, that money is coming back into the Federal Reserve via the banks who want to be paid interest. But that's fine, because the banks were being paid 0.25%, and they were earning 2% on the government bond. But now that maths has changed, those banks are earning nearly 5%, and those bonds are still stuck at the old rate of 2% until they mature 10 years or plus or more from now. So the Federal Reserve is the organization which funds the government, except the government is not allowed to be funded anymore. At least that's not the Federal Reserve's rule, that's Congress's rule. They've set the rule that there's a debt ceiling and it has to be raised. So this is what's being fought about, and I think they've raised the debt ceiling about 90 times in history. So there's no doubt in anyone's mind that sooner or later they will raise it, but there's always a risk that they don't. And as Janet Yellen has said, the consequences of not raising it would be disastrous for the currency, disastrous for the full faith and credit of the United States. It's inconceivable that we should ever get into a situation where they can't pay the bills. So Janet Yellen is expecting that debt ceiling to be raised. But of course, you do have arguments going on where each side is trying to hold the other side hostage. Meanwhile, Joe Biden says he's done his bit by producing a budget which will save, I don't know what the figure was, I think he said 300 billion or something, but that's not really saving 300 billion. What he's done is reduce the previous budget, so the amount by which they overspend will be 300 billion less than they overspent before, but they're still going to massively overspend. And it's been said last week in testimony with Janet Yellen that debt level is, I think it was Senator Kennedy who said it, that debt level is going to rise from something like 22, this is the government debt level, 22 trillion to 33 trillion in 10 years, by 2033. And he's asking, how is that based on, that's based on the official budget. He's asking, how is that a debt reduction plan? How is that a reduction in spending? It's obviously unsustainable. The response from Janet Yellen is, well, it is sustainable, provided that interest rates, and she did use I think a lot of people missed the word, but she used the word real interest rates, stay low. And she said, real interest rates are very low. And that's definitely true. They're negative because the nominal interest rate is, let's say, 4 or 5%, and the inflation rate 6 or 7% or 8%. So we have a negative real rate of about 4%. So she said, real rates are very low, and in that situation, we could sustain a much higher debt level than we have at the moment. But that's assuming that interest rates and inflation maintain that kind of relationship of having a higher inflation rate than we have interest rate. And that's not the norm historically. If we go back before 2008 and maybe about 20 years ago, we had very high real interest rates in America. I think it was about 6% real. In other words, the interest rate you could earn was something like 6% more than the US inflation rate. They were the rates, and I remember the rates were, because I'm referring back to the 1987 stock market crash, because I was having a look at things before and after. At that time, US interest rates were about 9.75 going on 10%, and inflation was about 4% in the United States, a bit below that actually. So we had real rates of around 6%. which meant that individuals, even who were depositing money, even after paying their income tax, still had a positive real return. That's been completely turned on its head in the last few decades. There's no place on the planet where you can get a safe return exceeding the inflation rate at the moment. Will that last? Will that absurd situation last? We'll wait and see. But if it doesn't, according to Janet Yellen's words, it'd be a big trouble for the United States unless they can cut their spending, which I don't think they can very easily.
No, I don't think so either. So you mentioned that you think the Fed are probably done with hiking and they're going to start pivoting soon. And then if we continue with, let's say the debt ceiling gets increased, they continue with the current deficit spending, what does that mean for the currency and I guess the system moving forward?
As they lower rates, the dollar will go down, and you can see it's already started doing that. It's already well down. If you look, there's a symbol people can look up on their screens called DXY. That's the dollar index, and they'll see that is heading downwards at the moment. And I think that probably will continue for a while. But there's another thing going on in the world. The BRICs countries are ganging up to trade between themselves in a currency other than dollars. So I think we saw the announcement a couple of days ago that Brazil and China will now trade between themselves, and apparently that's a very large trading pair. Instead of trading in dollars between themselves, they'll trade in renminbi and in Brazilian real. And I haven't read all the details about how this is going to work, but that's a decision. And I think that other countries are going to home in on this type of arrangement. So there's a lot of talk about something which was called the R5, which is a nickname for a currency which might exist, a commodity-backed country developed by the BRICs. So the R5 stands for the Brazilian real, the Russian ruble. By the way, Russia is now trading with China in the same way, rubles against yuan. The Indian rupee, big with R, the Chinese renminbi, the South African rand, and we now have a proposal or proposals by Iran and Saudi Arabia to join the BRICs. So that would add the Saudi Arabian rial, spelt with a Y, and the Indian rial, spelt RIAL. So that would be 7 R's instead of 5 R's. So it's just a nickname that people have given this fictitious currency which doesn't exist. But clearly there's talk about a new currency coming into existence by the BRICS nations, which would be commodity backed. Nobody really knows how that might work, but there's a lot of discussion about it. And if it gets some momentum, we might see at the early stages the BRICS countries trading between themselves in currencies other than the dollars. That's already happening now and decided. And 2, we might see some sort of commodity-backed currency emerging if currencies on this planet last long enough for that to happen and we don't have a crisis before then.
Yes, that would be obviously negative for the US dollar overall.
Yes.
How bad?
A lot of dollars would come home. They'd want to be spent, because if people aren't storing dollars to buy oil, they're going to find their way back home to America, and that would push up asset prices in America. It might be the savior for commercial real estate, for all I know, but certainly people are going to try and spend it on something. And whether that be Van Goghs or Apple shares or a building or land or businesses or commodities, it's hard to say, because you never know where. When people start to move their money, which direction they're going to travel in. And it could potentially even be, to some extent, cryptocurrencies, although I think America's a little bit on the back foot now with their attacks on cryptocurrencies. So I'm not sure about that.
It's scary to think, because as you said, there's so much dollars around the world internationally, and a lot of it's not actually in the US. And I think if you compare the US local currency amount to the China currency amount, it's actually lower. So there's less US dollars going around the US than there is the value of Chinese yuan. So if all that were to go back, you could imagine that would be really bad for inflation, especially asset prices would go up, but I guess you say overall value would potentially decrease. The real value probably wouldn't change, and then from there could
it would devalue the dollar
devalue.
too. So asset prices go up, value dollar goes down. So for somebody in another country, those assets aren't actually worth anything more. But yeah, it would be bad for the people who are left as bag holders of the dollars.
Yeah, definitely. So, Clive, thanks so much for your time today. I really appreciate it. So, my last question is, what is one message you'd like people to take away from that conversation?
We can have surprises, black swans that we're not expecting. Throughout my career of 47 years, I'm retired now, I've seen many black swans come and go, and there's nobody ever predicted what they were. So you have to be prepared for all eventualities. That means do not have all your eggs in one basket. Diversify.
I think that's a great message to take away. So thanks again for your time. If anyone wants to find out more about your work, I know last time we talked about LinkedIn. Is that still the best place that people can find what you do?
Yeah, the only place where people can connect to me is via LinkedIn. I am, up until now, responding to all the messages I get. I do get quite a few, but I'm very happy to do that for free. It's great fun. It's what I did in my career, and I was paid in my career. Now, like a retired doctor, people still come up during the party and ask you about their illnesses or ailments. I'm quite happy to answer to the extent I can respond to people. So yeah, for anyone who's got a question, feel free to fire it at me and I'll try and help.
Perfect. I'll put that in the description below. But yeah, Clive, thanks again.
Cheers. Bye-bye now.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.